In this video, we'll talk about WebStreet. WebStreet is former EF Capital. This runs a number of funds that connects uh, operators and investors and runs successful portfolio of online businesses throughout each of their funds. So right now we are at the dashboard of WebStreet as an investor. So we can see fund 8026 is up and live to be invested. And previously they have closed a number of other funds, and each of them have been around at least a million I can see, and it went as 3 million before. Yeah, 3 million. So right now the fund that they have opened for investing is from 3 million to 5 million. I guess the market is good enough so that they are going for a bigger expectation. So I will try to explain how WebStreet works and what does it mean for website investors and website operators, and in the game, where does WebStreet takes place and how does it play their role to make sure the fund is created, invested, and operated and exited properly. So if we go into the details of this fund, we'll see there is an investment summary which pretty much talks about what they have done before and how many good number of portfolios they have closed 18 funds before, they have acquired 33 assets before, and they split the profit quarterly on a 3 to 4% interest rate, which is good enough. If you sum up, it becomes 12 to around 12% per year, which is good enough and better than maybe many of the financial institutions what they're offering, right? So WebStreet is to be Empire Flippers Capital. For those who don't know, Empire Flippers is one of the biggest marketplaces to buy and sell online businesses. And by online businesses, I mean businesses that are already making good amount of money and they're into positive cash flow. Those businesses can be bought and sold in WebStreet, in Empire Flippers and other marketplaces. So when it comes to investing, WebStreet is trying to be an holding company, an investment firm that lets investors invest into profitable digital businesses, and investors can compare it to other, digital investment opportunities like Bitcoin or buying arts or buying NFTs. These are also digital investments, but what WebStreet particularly focuses is profitable online businesses. By that, they have named three kinds of businesses that they usually invest into. One is Amazon FBA, another is content website, which are monetized by affiliate marketing, and also content websites that are monetized by display ads, and another is e-commerce. So FBA, content websites, and affiliate websites, and also alongside FBA you can call FBA and e-commerce is the same thing. So yeah, that are the businesses or business classes that WebStreet invest into. So they have got a very good track record of running, operating, and managing content websites and other kinds of digital businesses, because when you run a marketplace, you have a very unfair advantages of getting access to all of those buyers and sellers who want to sell and buy online businesses. So that is one big advantage, and I guess that is one of the factors that led them to start WebStreet as a fund, because they have access to all of the buyers who are selling websites, and they have access to all of the they have access to all of the sellers who are selling websites, and they have also buyers who are buying them. So they just started to get into the game and act as a middleman between those buyers and sellers, because often the seller doesn't have enough fund to keep investing into businesses, and the investors, they don't have enough knowledge and experience to run those businesses. So WebStreet is becoming that entity that connects these two parties and makes sure everybody is working for their best interests. So if you look at the detailed information in here, you'll see they have clarified the terms for investors, operators, and WebStreet itself. So we'll have more documentations explaining how does it take place and what everybody gets. For now, I guess let me put it down in this way, in as simple as possible. If you are investing, if you are an investors, they will have money from you that will be mostly utilized to acquire and operate the businesses. If you are an operator, they also want you to have an ownership and sense of ownership within these businesses. So they also ask for about, if I'm not wrong, then 10%. Yeah, 10% of the businesses. So even if you are an operator, you need to invest 10% of the businesses, of the the total acquisition and operating cost. And meanwhile, they will act as advisors. They will deal everything. They will they will make sure the acquisitions are right. They will help you with the due diligence, and whenever you are operating the websites as an operator, they will be your go-to source for any kind of information or knowledge or advice or stuff like that. So they'll also take a certain percentage of the entire profit. Now, investors, they get a quarterly return of whatever profit the website or businesses make. Also, the operators also receive a percentage of the profit, and that is the salary for the operator. The operator does not receive any monthly salary or compensation. Whatever profit the businesses are making, they will be split on a quarter basis, and that is the benefit of the operator. But when the websites or businesses will take exits, then it will be a real game changer for both operators and investors, because before that, those quarterly dividends are just they're just an assurance the businesses are doing good. But you see the big money when the websites are actually sold to another buyer, right? That's how online businesses works. So if we look at how they are planning the split and how it works between the investors and the operators, this is pretty much the summary of the portfolio manager, the operator, right? So if the acquisition value is $2 million, and if the multiple is 36, then the monthly income becomes $55,000. So whatever website or businesses they're acquiring, it's already making $55,000 a month, and the annual return of investment is 33%. If you click at those cells, you'll see how they have calculated each of the each of the outcomes, and how they have entirely formulated. You can even change these numbers here and see what return you get of any acquisition value, right? And you can do it for rest of the sheets, where there are three more sheets in this file. So profit breakdown is like the investors will get 66% of the profit, and other entities will get 33%. So within other entities, the portfolio manager will get 20%. From initial investment, it will be 3.3%, and entirely the portfolio manager will get 23.3%. So 23.3%, 66.6%, these two are for the investors and portfolio manager. And if you add it up, you'll see that there is another 10% which is going to the operator, sorry, the managing platform, which is WebStreet itself. So that's how the profits are distributed. They have created a detailed breakdown of how it will look like once the websites are taken exits. So usually WebStreet mentions that the exit will be done within any time span between 5 to 10 years from the time of acquisitions. But they have also said that they have taken exits on the 6th year or the 7th year very frequently. So it's not very rigid terms of conditions that you cannot expect anything before 10 years is elapsed. Usually it depends on the situation of the business. If it's worthy of taking an exit, if it's a good exit, then they will go for it. And of course, they will make a collective decision, because that's where the advisors are, right? So if you look at the numbers, you'll see the entire investment. It runs around the websites or businesses for 3 years, and that's the first year after acquisition, second year, and third. So in each of the year, they are calculating an annual ROI of 33%. So yeah, so if the website is making $55,000 when you are buying it, they won't share any profit for the first 3 quarters. They'll do the split in the fourth quarter of the first year. So if you look at the formula, you'll see they're multiplying the monthly income by three in the last quarter, and which is becoming about $166,000. So from that, 63% will be to the investors, and the portfolio manager will get 23%, just like that they have mentioned in this in the first sheet, right? 23% and 63%. This will be the split. So in the second year, they have projected an annual growth rate of 10% in the first year, because I believe they will, they will implement some of the quick wins. They will do some changes that will initially boost up the profit margin in the for very first year. And in the second year, it will be 5%. It will be a bit steep because they have done whatever they needed to do to make sure the profits are maximized. Now they are just constantly increasing the magnitude of whatever worked for the website, right? So the profit margin, also the growth rate, will be 5% in the second year. So in the second year, according to this formula, they have increased it by 5%. Yeah, they have increased it by 5%. Yeah, which comes into the third year actually. So this is the first year of where actually the profits will be splitted within each quarter, and this is the second year according to this formula. So the profits are being splitted, and when the website will take an exit, the situation will look like this. So monthly net profit in year three, considering the businesses are making this much of money in together in the entire year, it became 64,000. So it got acquired when it was making $55,000 per month. Now after third year, it's making $64,000. So they have made a very decent projection of how much it will grow in terms of revenue and profit. I guess it will be more than what they have projected, but I understand if they want to, keep things skeptical and keep the expectations low for both investors and operators, because anything better than that will be awesome. But anything less than that, they don't want to see this because they have to keep the record clean, right? So after exit, the website will make about 2.3 million, and the multiple exit multiple is 41. So the initial acquiring multiple is 36, and the exit multiple is 41, because I believe when you are acquiring a website, you'll be looking for as low multiple as you can, right? Because there will be so many options to choose from. There will be so many business classes and different sellers from different parts of the world. So not everybody will be looking for the same kind of multiples. But when you'll be selling the website, they will be on the other side of the fence, right? So they will look for the highest bidder. So that's where they have increased the multiples from 36x to 41x. Anyways, this will lead to an exit fund of 2.3 million, and this is the monthly profit. So yeah, so this is the monthly profit, I believe. So it will be 2.3 million plus whatever they have distributed before. So to portfolio managers, they look like they have distributed about 30 $389,000. And to investors, they'll be making about $1 million plus, right? So in together they'll be disbursing about 1.6 millions even before the exits were taken, right? And from exit, there will be a big amount of cash, which is 2.3 million. So if you add it up, it will be about 4.6 million that they have totally, that entire revenue of the entire monthly yearly net of these businesses. So net return, if you consider the net return, the investors will be making about okay, so this is the net profit. So they have calculated that, okay, from the entire amount of revenue, they have deduced the sales price. I mean, they will be returning the investment back to the investors, and then there will be $2 million, from which the investors will get 63%, and the portfolio manager will get 23%. All right. So the return of investment for the portfolio manager is 480%. How they have calculated it? Okay, they have said that the initial investment from the portfolio manager will be $100,000, and it will be $1.9 million from the investor. So the return is 480%, and the return is 69% for the investors. So now this makes sense that you are getting 480% return of your money. So you should keep working, because you're not being compensated for all of the works you'll be doing as a portfolio manager. So this is your compensation. You're getting 480% return of the $100,000 that you have invested. And for the investors, I believe the number is still good. It's 69%. It's more than any other investment forms that you can possibly imagine, physically or digitally. Plus, it's a very certain business model. So things are mostly within control. Whatever you do with those businesses, you'll get an immediate results. But some things might not be in control, like Google updates on, or algorithmic changes of the platforms where you market your product, or maybe your product or business class can go out of market, it can go out of trade. So apart from this, I believe this is a pretty good return of money for both of the parties. And if you look at the annual ROI, it looks like it's 160% for the portfolio manager and 23% for the investors, which is still good. And the total is 34%. Okay. So this is the quarterly return and quarterly ROI, because all the calculations have been done quarterly, and this is the yearly ROI. So yeah, that looks like a good deal. And people who are looking for alternative investment classes, it's a very good proposition for them. And people who are actually they hold the expertise of running online businesses, this is a good opportunity for them as well. Apart from the return of money, you are getting to run businesses, and you'll get a very good amount of fund in your hand to utilize all of the expertises and experiences that you have gathered in years. So to me, I believe this is the future of investment, right? Because people don't want to invest in physical assets anymore, because these are very limited resources. They want to go to somewhere where it's not limited, the amount of resources that you can invest into, and that's online, that's internet. Now in internet, there is a lot of things. There are things which are almost gamblings. There are things that might be good, might not be good. You don't have any control over it. And then there are businesses like this, where there will be experienced people who will run and manage the businesses that have been invested. There will be an entity like WebStreet, which will oversee the entire operations, the acquisitions and everything, who have even bigger expertise of running and managing online businesses. And then they're being very transparent about all of this. They have provided literally every detail you need to know about their previous funds. So this is track record, right? Whenever it's about brokerage, track record is everything. So track record looks like is pretty clean, pretty good, no matter if there were COVID or if there were any economic crisis. They have always made positive amount of returns to their investors. So from fund 8025 so to 8015, 8014, they have been closed, and the ongoing ones are here. There are about 8 funds that are currently ongoing. They haven't taken any exits yet from those businesses, and they're literally telling you everything, whatever they have been, how much they have been investment, they have been investing, and what kind of businesses were bought and run using the fund. And if you want to look at the detailed, they will also tell you about who is the operator and the background of the operator and the interviews. So this is transparency. This is transparency at its best. So you can look out and check out everything that you need to. You don't have to rely on someone just on their words. This is clean track record, and I believe this is where the future is going when it comes to digital investment. So yeah, that's all. I think I took a few more minutes that it required to, and this is the very first video. So I believe I will try to make things better with whatever the topics of the next videos are. But for now, that's it. So yeah, bye bye.